Hello, everyone. You're listening to the Advocis Podcast. I'm your host today, Cindy Marques, and I'm joined by two wonderful gentlemen, Andrew Cairns, Jeff Thorsteinson from HomeEquity Bank. Really looking forward to talking with you today. Welcome.
Great to be here, Cindy.
Great to be here, Cindy. Look forward to it.
Okay, well, why don't you start off by telling me what is HomeEquity Bank and what do you do primarily?
Well, sure. HomeEquity Bank is a specialty bank that is involved in only one business only, and that's the reverse mortgage business. We're recognized as the pioneer with the CHIP reverse mortgage program. 38 years of doing one thing well, and that's reverse mortgages. And it's very typical to see our business grow somewhere in the neighborhood of 20 to 30% per year. So it's a very quickly growing business in Canada.
That's interesting. It's very quickly growing. I think that there is still a lot of stigmas in the advisor community about taking on debt or using your house in that way going into retirement. So it's interesting you say it's growing. Can you expand on that a little bit?
I would say it's growing because the household balance sheet has changed over the last, call it 20 years. You used to have defined benefit pension plans and investment and savings and then government plans. And with the decline of the defined benefit, defined contribution hasn't really made up that gap. But what has made up the gap is home values have become now the single largest asset class in the typical Canadian household. So this is what's really starting to drive that growth is people need income.
Yeah.
What asset class is growing? The home. So they need to tap in and release that equity in some fashion.
Yeah, for sure. I was speaking with an advisor recently, and they admitted to me that, heck, there's a lot more $1 million houses in my market, my community, than there are $1 million accounts to transfer to my business. So that's definitely a true fact.
So you bring up the decline of the DBP. Would you say then that these reverse mortgages are primarily being used to bridge retirement income?
They'd be used, there's a number of ways, and I'll let Andrew get into some of the nitty gritty because he's engaged with the clients far more than I am on a day-to-day basis. But certainly bridging income is a key element. Mm-hmm. But there's also kind of we would classify as wants versus needs. So bridging the income is a need, but there are other clients that are in a position in their life where they have a special want out there. Andrew, maybe one might come to mind that...
Well, there's always an interesting one every day when we work.
Let's hear it.
And definitely the want side of the equation is more interesting. But, where I take a half step back is to talk about the consequence of taking action and incurring taxable liability. So, definitely there are groups of clients out there that they're asset rich, whether that be an investment or the cash surrender value of a policy as an example. But there's consequences for them to take that money to activate it to some aspirational goal, like a vacation home, for example. Mm-hmm. So therefore, if there's a way from a tax preference standpoint to tap equity that you have in order to make a comfortable purchase of an aspirational venture, great. So lots of examples. And the most recent one, which is fascinating, was an 84-year-old car enthusiast. She was a widow with a 2017 Corvette. And this person has a lot of income and a lot of assets, but her aspiration was to purchase the brand new Corvette. And I had no idea how much it cost. And then I was told it was about $145,000 with all the bells and whistles on it. And, at 84 years of age, she would have to set aside a considerable surplus from her income sources in order to afford that asset, whereas she already had the asset in a condominium, in this case, almost worth $2 million. So this was a very easy decision for her. So these are the more interesting reverse mortgage stories in order to help people accomplish their dreams. And we see this every day.
Okay, so what I'm hearing here is that this product is not really, a means of last resort income. People are using this aspirationally. It's actually a great strategy to accomplish the things you want to do during your life, as opposed to, I just didn't save enough for retirement. So you're seeing a lot of that.
Yeah, it could absolutely be a great strategy and a highly tax effective strategy. But before we get into those specifics, we do certainly have the clients that are short on income. They may be house rich, down to their last couple $100,000 in their RIF, 72 years old, and need to make up some of the difference in cash flow. And so we absolutely have those clients and serve those every day. But the aspirational ones and the smart use of CHIP, I think, Andrew, you could get into a little bit more detail on that side of it.
Yeah, for sure. Last resort is sort of not really the advisor's purview. They're generally dealing with people that have accumulated some wealth. They just want to do it, in a smart way. There's, some of the more interesting aspirational things that we see is the purchase of real estate, vacation homes, as an example. There's somebody that's worked all their lives. They've entered retirement. Maybe they have a small amount of debt, $60,000, $70,000 with a home equity line of credit. They don't like the monthly payment associated with that. So, the first step in a reverse mortgage is typically paying off a home equity line of credit as the first step. But then, because of usually significant amounts of money that are available, a retiree couple or individual can look and say, what is it that I really want to do? And if the time is right for example, an overseas property or the completion of the old family homestead or a cottage that's in need of renovation, these are all things that we have seen on a regular basis. There's one additional detail that is very fascinating about reverse mortgages that I've seen in practice over many years has been people using the privilege to blanket in a reverse mortgage with multiple Canadian properties. So if an individual puts a reverse mortgage on their primary residence and then they choose to use their cottage, for example, that's a Four Seasons cottage, they can take the combined value of the two properties into a total reverse mortgage solution. And the benefit there is more money available to them.
Okay, so this is very interesting, and maybe we need to expand on some of the fundamentals here of the reverse mortgage so that our audience understands this better, because it sounds like a great tool to leverage. Let's talk about, first of all, who is eligible for a reverse mortgage?
Yeah, sure. So, relevant to the insurance business, I'm going to borrow a term, which is joint last to die.
Yeah.
So a reverse mortgage is simply legally a mortgage that's placed on a property. So the applicants both must have attained a certain age, which is 55 for a reverse mortgage. So if you have a situation with one spouse that is in their 60s, but one is in their early 50s, sadly we cannot move forward with that solution. And the reason is matrimonial laws throughout Canada indicate that the home will pass to the surviving spouse.
Yeah.
So therefore, the rights of a reverse mortgage contract, have to pass to that surviving spouse. So we use an actuarial calculation that's driven primarily by the age of the younger spouse in order to make an assessment of how long likely somebody's going to remain in their primary residence. So a 55-year-old could be in their home for 20, 30 years. An 84-year-old, might be in their home for another 10 years, let's say. So the moving part of the seesaw in that equation is the older a client is, the more money they qualify for as compared to a younger retiree, as an example. So each one of those reverse mortgage is a customized contract for that client's specific situation.
So that's very interesting. It brings something to mind, a client who goes into retirement already banking on this strategy, knowing that later in life, I can take a reverse mortgage, but then they decide to marry someone quite young. And that's going to limit how much they can access or potentially exclude them from taking part in a reverse mortgage altogether. Have you seen a lot of these scenarios where, what I wanted to bring up actually is the older gentleman starts a reverse mortgage. What if they get married once the reverse mortgage is already in play? Does that change anything? And let's say they'd like to add that person to title. What kind of complications arise there, or does that even work?
Yeah, so it definitely title is frozen in the name of the person that has the original contract. So another spouse coming into the situation would have to essentially refinance their reverse mortgage arrangement as the new party there. So there's no privilege that is given to the new party that comes into a marriage arrangement. And interesting, a lot of people don't know this about the reverse mortgage business, is because the duration of a reverse mortgage is fairly long. It's a decade or longer, right? It is very, very typical that a client will come back to us later to say, we did this reverse mortgage when my home was valued at $700,000. What's it worth now?
Yeah.
And then you discover, hey, it's worth $1.3 million. As an example, very, very typical in the Greater Toronto marketplace. Well, it is possible to refinance that reverse mortgage given any new arrangements, and perhaps that might make more money available to that family.
Okay, and so what are the qualification criteria on the home and how it's used? Because you mentioned blanketing it over multiple properties. So does there have to be some sort of principal residency rule there in order to qualify? Or can I do this on a rental home, for example, an investment property?
Yeah, well, it goes back to the basics of a reverse mortgage. Reverse mortgage is also unique in that it is a mortgage that doesn't have a term right at the beginning. It's not like we going into your bank branch and saying, I'd like a 3-year mortgage or a 5-year mortgage. The way a reverse mortgage it works is there's no predetermined term. The term is as long as the person stays in their house. So, the most important thing is what is that house? Really, at the end of the day, we already know the age of our clients. We've already made the actuarial assumptions, not unlike in life insurance. But now let's really find out about that house, and that requires a detailed appraisal to really determine how much that house is worth. And then we apply the calculation or the percentage value against the house. And we set in stone, in other words, a limit to the amount of money that a person can borrow. And here's a misconception a lot of people have, is I have a $1 million house and I qualify for, let's say, half of it. And that would be somebody in their 70s, for example, half the value of the home. Very few Canadians come and say, I'm going to take $1/2 of $1 million. And that's a really, really interesting point. Usually you find the clients want to take out $100,000 to, for example, gift to a child or to do an equalization as a living gift is a really, really common thing for advisors in reverse mortgages. Well, that leaves essentially $400,000 worth of what I call dry powder for that client to activate in the future. But the better way for like an insurance professional really to think about that is it acts essentially like an emergency reserve. Think about it like that extra, layer of no cost insurance that the client could get access to if they need to, but they're not under any obligation to take it initially. It's very, very conservative.
So once you've been approved for certain amounts, I only take some now, but I can just grab the rest of that when I need. I don't need a thumbs up from you again. Is that what you're saying?
You can call us and request the subsequent advance, we call it, and we can put that into your bank account within a few business days. That's
great. It's like that commercial. It's my money and I need it now. That's how it's working.
Yeah.
But again, just sort of driving back to with multiple properties, does it have to be because I feel like you're very specific in saying all seasons cottage when you use that example.
The anchor property is the principal residence.
Okay.
And then you can add other properties to that.
Do those have to have some kind of like you need to be there a certain amount of time and using it? So can I use a client use an investment property? I don't even live there. I rent it out, but I own it. Can I blanket that under it?
Yeah, for sure.
Yes.
Absolutely.
Yeah?
Absolutely.
Okay.
So naturally, the principal residence is how we determine like if a person is living there. If they're not, then that's the end of the term of reverse mortgage, which means it has to be repaid. When you blanket in multiple properties, and we've had several in Toronto as an example, where a person owns 5 or 6 properties on the same street and they want to buy the 6th house, right?
Yeah.
So they can take their principal residence and add 1 or 2 additional rental properties. Those properties, to answer your question, have to be considered homes. They can't be, blended units with a retail store on the bottom and all this kind of stuff. They actually have to be homes, but they can be rental properties.
Interesting.
And yeah, you can blanket in multiples. And I've seen some streets where the reverse mortgage has been used to fund the purchase of the 6th home. It's fascinating.
And as a snowbird, you can spend 6 months less a day in Florida or Arizona, but that's still your principal residence in Canada.
Yeah.
Very interesting. You brought up the blended unit, which now leads me to think, okay, well, what if it is a home? It's a single family dwelling, but there is a detached basement and I rent out the basement, but I live in that upper levels of the house full time. Does that change anything?
No, not really. There's some technicalities in there in terms of like they can't be a contract for 10 years with that tenant type of thing. But if it's a standard roommate situation or a rental apartment month to month, then that's not a problem.
And you wouldn't like prorate the amount of equity available, like if half of it is rental, half of it I live in. You wouldn't say, okay, only half of this equity. Okay, that's very interesting.
Yeah. The blanketing. The most common usage is actually the Four Seasons cottage.
Yeah.
So, and there's lots of reasons for that. Like, definitely, a cottage and a home are an asset, but it's an asset that's always sucking money. So, some of these larger homes that I've been involved with, it's not untypical to see, $30,000, $40,000, $50,000 a year of just upkeep on the house to keep it properly shingled. Think about the cottage and the property taxes and all this sort of stuff. So you have an asset that's accumulating in value, which is great from an investment standpoint, but who's maintaining it and where's that cash coming from? And if it's coming out of your retirement savings, ouch. What really makes a lot more sense is let the house pay itself. Right.
Mm-hmm.
And, that is one of the solutions where the reverse mortgage can be used for that upkeep or upgrading of a house too.
So you mentioned, maintaining your cottage. I'm curious if someone undertakes a reverse mortgage and they don't do a very good job of upkeeping their own property and that causes it to fall in value. Is there rules around that? Do you check in on that? It substantially decreases. What happens in a scenario like that? Has it happened in a case that you encountered?
Well, it does happen.
Yeah.
It doesn't happen very often. And the property owner's responsibility is to pay the taxes, municipal taxes, and keep the property insured and keep it up to date, maintained. But we don't have a great way to ensure that. We don't have people that we send out to check that kind of
survey.
thing.
Yeah.
So it is at the end of the day a business risk that we take as a bank that could possibly happen, and occasionally it does, and then that's a risk. And then at the end of the day, then there could be a negative equity situation.
Yeah.
But we have a no negative equity guarantee, meaning the end client can never owe more than the value of the home. So if that scenario happened and the home was sold and the equity that's left is less than what is owed to the bank, that's our problem. It's not the client's
interesting.
problem. Yeah.
That's good to know. Take notes. That's very neat. Okay, what are some other fascinating details? Not to cut you off there, Jeff.
Yeah.
Finish your thought before I get into it.
Well, we all of our underwriting is geared to try to prevent that from happening.
Of course.
but it does happen, and
okay,
it's just
so
the cost of doing
it's
business.
a true guarantee then.
Yeah.
What are some other fascinating details about reverse mortgages that I might not know as an advisor and our viewers may not know?
So just taking that question, just kind of flipping it a little bit. We often speak with advisors, and there's a lot of sort of misunderstandings. I was just at the Advocis Bank School last week, spoke with a lot of advisors. And what would you say, Andrew, the kind of some of the typical misunderstandings are when you're speaking with an advisor?
Yeah, I would think the biggest one is that somehow or another the bank owns the house. And it's not the case. Legally, it's like a mortgage, any other mortgage. It's a charge against title. So pretty much the entire Canadian population is used to or have had experience with mortgages. Well, it works exactly the same way. So there's not or the perception that there's a bank that's going to take over the home or the bank is going to sell the home when the person runs out of money is simply not the case. In fact, really what it is our actuarial skill is to make sure that we don't lend too young a client too much money. And it sort of circles back to your original question. It's like, well, how do we assure that a person keeps up their home? Well, usually because and this is often forgot about with housing is, if you think you have $1 million house that's growing in the market at whatever rate. And, I know in the old days, 5-6% was sort of common or what people were counting on. But even 2%, given the rate of inflation, that means that $1 million house, just by the act of staying there, is a client's gaining approximately $20,000 worth of equity. And, given the fact that most clients, take out $100,000 or $200,000, even though they might be approved for a lot more, is like the interest accumulation is relatively small compared to the increased value of the home. So clients are essentially building equity in most reverse mortgage scenarios. So why would you not want to take care of the place?
Yeah.
This is your house, right?
Yep.
And, more often than not, Cindy, is what we're really seeing is people being really smart about using the cash. They're really conservative, but they're doing good things. One of the more common ones that people don't think about is realizing that a home might have to be sold in a few years, but there's a lot of shag carpet in the house, and there's a wallpaper.
God, yeah.
Wallpaper. And I often joke, we go out and we say, I'm in the shag carpet removal business, because how is somebody that may want to downsize their home at some point in the future? How are they going to get maximum bucks? And they don't have $40,000 lying around to do a new granite countertop, but they know that that's going to add value to the house. So it might be typical for somebody in their, let's say, early 70s, knowing that they might have their eye on a condominium 8-9 years from now to do that, which is great because they can sell their house at any time. There's another big myth. You can sell your house whenever you like. Mm-hmm. But, why don't you get your place real estate ready, and get it all fixed up so that the next buyer that comes in, is looking at a great real estate product, right? Where's that money going to come from? If it comes out of an RRSP, out of a RIF, for example, that's a bad choice to take money that's taxable and then put it into your house, right? Don't do that. Yeah. And that's really, where we get the ball rolling from a financial planning standpoint. And that's, Jeff and our expertise. Yeah.
Which makes me think too about it's too expensive. That's often hear that. I heard that last week many times.
Too expensive to renovate?
No, a reverse mortgage
yeah, okay.
is too expensive, meaning the rate is too high. And so I often ask advisors, "Oh, well, what are our rates?" They don't generally know, but they think that they're too high. Well, in fact, our 5-year fixed today is 6.69.
Yep.
So we're about 150, maybe 175 basis points more than a conventional 5-year fixed. We're also lower than a HELOC and have been for a while. So when you start to take a look at that actual rate, it's really not that high.
Yeah.
Plus, you never make a payment. So there's a time value of money around not making a payment.
So let's start to pit some products against each other. Let's do reverse mortgage versus a HELOC. Let's talk about some salient differences, pros and cons.
That's a really important one, right? Because the HELOC is, in most people's minds, the go-to solution, right? Yeah. If I need $100,000 because I need a brand new Suburban vehicle, right? I'm going to go to the bank. I've been dealing with that bank branch for years. I am going to ask them for a $100,000 home equity line of credit. Well, first and foremost, Jeff just said it, is the rate on that typically, but right now, currently, while we're talking, is about 7.1%. They can go get $100,000 from HomeEquity Bank chip reverse mortgage at 6.69 as an example, right? But they're two different products. One has a monthly payment that nobody likes, and the other one essentially pays it forward in terms of deferring the interest cost on that. Yeah. And if you're a retiree with limited income, do you want cash out of your pocket right now? Most don't. But that's a mythology. People really have to get used to the concept is, if I do take on debt, it has a consequence of cash flow cost.
Yep.
A reverse mortgage, by contrast, if it's cheaper and it has no cash flow consequence, not until down the road, and it's against an asset, a house that's appreciating in value, it's a good deal.
Yeah.
The other thing we hear, like HELOC versus chip, we hear that all the time. The other thing is, why not just downsize? And that instead of using either debt mechanism. And so that's a whole area that it's easy to say, but when it's time to actually do it, it becomes very, very tricky. So if you want to stay in your neighborhood or in that part of the city, try finding something today that's actually cheaper. And it's almost impossible.
Yeah, that's true.
So you really don't free up the equity that you think you do.
Yeah.
So we don't have to repay. We like that about the reverse mortgage. But what if you wanted to? Because you brought up the example of, all right, I want to sell my house, but I need to work on it first before I sell it. That's a quick turnaround if I need money now, but I'm going to sell this in a year. Are there any penalties or minimum requirements to stay into a reverse mortgage. Talk to us about that.
Yeah, sure. Well, Jeff mentioned property tax insurance has to be paid by the homeowner, but there is no obligation to make any payments on a reverse mortgage. But it's an excellent question because of the time that we are in right now. We're in a period right now where a significant number of people in their 60s and 70s have already taken out debt. And that debt was all taken out 4 or 5 years ago at better interest rates. So the conventional mortgage, it's not unheard of to see, 2.1%, 2.2%. It's all now coming due. It's all now coming due in 2024. And they're now having conversations with their bank manager saying, hey, your new payment was $1,000, let's say. Now, guess what? It's $2,200. And they're going, where is this money going to come from? So this is the big conversion from conventional debt to reverse mortgages right now. And, that leaves the really interesting question is, well, that retiree had $1,000 a month they were paying before. What if they feel more comfortable paying that? Absolutely. A reverse mortgage, and this is often not mentioned, is you can service it. You can actually customize. So you can say, I would like $100 a month taken from my bank account. You can customize it all the way up to the full cost of monthly interest. So what that opens the door to is a people that want a better deal because the rate's lower than a HELOC.
Yeah.
Then they want to make some degree of monthly payment, but they don't want to get the new rate payments. They want to just keep it more reasonable within a budget. There is where a reverse mortgage has an excellent fit. Yeah.
That's super interesting. I didn't consider that you could replace a regular mortgage with a reverse mortgage. So in instances then where your remaining mortgage is less than 55% of the value of your home, because that's your lending maximum, correct? Mm-hmm. You could just get a reverse mortgage, pay off that mortgage that just came due, is going to renew at over twice the amount, and now service the reverse at your leisure.
Well, we're sitting all the time with this. Like we have some very significant debts out there. These are reasonable people, they're business people, but they have accumulated debt for whatever reason, and on large homes. And they're concerned because they know their renewal's about to happen, and they're thinking exactly like that, Cindy. They're going, if I can replace my monthly pay debt with a debt that does not require any payment whatsoever, great. But I'm still willing to punch some money into that equation. Can the reverse mortgage give me that flexibility? And the answer is yes. Yeah. That's exciting. So it's sort of like a supercharged mortgage in many ways, but it's not for everybody. And this is, if I could clear up one mythology, is we're approached by people that say, hey, this reverse mortgage sounds wonderful. Can I apply? And they're 49 years of age. And of course, it's a non-starter. Yeah. Right. And the other thing is, let's say they're 55 years of age. Well, it's typical to find that we can lend maybe 23% of the value of the home. And that's not enough to cover the existing debts. Mm-hmm. So there's a bit of a sweet spot for reverse mortgages. It's, sort of sits in somebody around 70 years of age and older, seems to be where it really, really makes a lot of sense. And that's why, Jeff was really smart. He said, we need experts out in the field to explain this to people, right? To clear up all these point-in-time mythologies. Yeah.
Well, that's what this podcast is for, hopefully, to educate us. Yeah. Because, look, it's not unheard of for me as a planner to run into retirees who are still carrying a conventional mortgage. So obviously not for my younger clients, but this is a great solution.
It is. Yeah, that's a growing segment of the population going into retirement with debt, and they may have taken it for a whole variety of reasons. Help kids get into the real estate market or through a divorce situation, all sorts of reasons. But now that, as you said, Andrew, that it's being renewed at significantly higher rates, and it's a major cash flow issue.
I wonder if you'd be able to speak to this. I want to pit another product against it. A strategy that a lot of advisors love to use is the insured retirement strategy. You take on, you overfund a large part policy. You're going to use those cash values eventually down the line to secure, to obtain a secured loan. Take that as income in retirement. Policy pays itself off when you pass away. Can you speak to the similarities there? I mean, I imagine, the insured retirement strategy is something with a lot of foresight. You're talking to someone younger about that, whereas maybe the reverse mortgage is. Do you have a lot of people like early in their years already planning for a scenario like this?
Well, I would suggest to you that the average consumer is not looking at the parity or comparing. It is the professional that's sort of more familiar
Yeah.
with that, and be it a back-to-back strategy or whatever, is there's a lot of similarity between reverse mortgages and various insurance strategies. However, in practice, I actually find there's a disconnect, and that is based on insurability. So there might be a lot of target clients that hypothetically might benefit more, let's say, by an insurance strategy, but yet they don't qualify for insurance. So therefore, it's out the door. So, not that reverse mortgages are primarily targeted at people that are uninsurable. It's just rather the demographic is so significantly different than what the average insurance advisor has been focused on in the past.
Yeah.
So this is why I think it's a great home for the Advocis membership to really, really investigate where this fits, and probably even more important, where it doesn't fit, right? And really come at it with a critical eye as to, I now have a brand new arrow I've never had before, and I can use it for a select client.
Yeah, that's very neat.
Cindy,
What else do you want to bring up here? I see gray divorces as a point of topic. Oh, that brought up a smile.
Well, Andrew just did a podcast on this topic, and we're actually going to be rebroadcasting it when 2 weeks from now.
Yeah, in a couple of weeks, and this is the one that shocked us. It shocked us when we first ran into them about 3 or 4 years ago, and it was sort of coming out of COVID, and it was the number of advisors that we got called us and said, "Guess what? One of my best clients is they've announced their separation." How old are they? In their late 60s or early 70s. I'm oh my goodness, this is, I'm not going to say it's an epidemic, but it's it's real. And, it forced us to, make connections in the industry, to chat with, divorce specialists, that, really can help manage that outside of the legal, the legal teams, there's counselors and things like that, and just open up this really, really interesting marketplace for us. And here's how it goes. It's if, you have a couple that's splitting up and they have their most significant asset is their home, and there's a desire for somebody, perhaps some adult children are still living there, somebody wants to remain in the home. How does that person settle up and pay the other spouse? Well, if they're retired, they can't waltz into a bank branch and say, "Hey, I want a mortgage for half the value of my house." They just simply don't qualify. They don't have the income to do it. So, it's always been a real stressful time. But now with the reverse mortgage, which frankly is qualified without any real consideration to an individual's income, they qualify based on the value of their house. This could be the big check that pays out the other spouse. And, we've managed several of them. They're never pretty. They're never fun, but it gets the job done. And it's a unique aspect. It takes months usually, but this is a source of funds.
And it does allow the one spouse to remain in the home, which was critical to that spouse.
So this is a scenario where there was no reverse mortgage. They split, but they're using a reverse mortgage to pay out the other. What if they've taken on the reverse mortgage together and then they split?
Oh gosh, I've not seen that one yet.
Not yet?
Not yet, Cindy, but I'll have to I'll have to think about that. But the bigger issue, frankly, is investment assets, because when there's a split, there's naturally, it usually, depending on the specific situation, if one spouse inherited money, in the past and how that's dealt with. But let's say, just as a parity, that there's going to be a split of assets. The investment advisor is going to lose 2 clients because all that money is going to be cashed in at huge taxable disadvantage in order to pay out and swap hands, and not to mention the lawyers. But it's not going to be fun. It's not going to be friendly, right? And it's certainly not going to give an option for somebody to live in a home, one of the spouses to live in a home that they're comfortable in. Here's a way to do, I think, 2 or 3 things. And first, allow one spouse to stay in the home that they love and comfortable, and maybe that has responsibility to take care of children too at the same time. It allows them to pay out the other spouse who's happy because now they have cash, but now there's an equitable split of investment assets without having it to be cashed out, right? And the taxable consequences of a deemed disposition for capital gains, or income disposition for a registered asset that's being deregistered, type of thing. So it's a win-win-win, and for it's not pretty though.
That's fair. So we talked about various ways to use a reverse mortgage. Maybe two more that we can touch on before we wrap up. Let's talk about the costs of aging and, the medical care associated with that. And then maybe wrap it up with just general inheritance and gifting to adult children or grandchildren, etc. Let's start with healthcare costs and long-term disability, things like that, where you didn't see this coming or you didn't have enough money set aside for these things that happen.
There's a whole lot in there.
Who will answer first?
Yeah. I mean, the costs, as everybody knows, are becoming astronomical.
Yeah.
And so long-term care, which is super expensive, $5,000 to $10,000 a month, and nobody wants to go into long-term care if they can avoid it. So we often see clients that will use reverse mortgage to set their home up properly so they can stay longer, but then also frequently find one spouse needs to go into long-term care, but the other's not quite ready.
Mm-hmm.
So how do you actually fund that $5,000, $6,000, $7,000 a month? So we use the reverse mortgage to provide that cash flow to allow that to happen.
That's a big one, Jeff. Like people completely underestimate this, is that there's no two spouses that get sick at the same time usually. And there is that exact scenario where, a couple is comfortable in their house, somebody gets ill, and somebody, can't even have home care.
Yeah.
And they have to go into a long-term care facility. And that $8,000 a month bill starts racking up. Plus the cost of maintaining the house for the other spouse.
Yeah.
It is expensive. And this is, my most common experience with the reverse mortgage is essentially a blended solution to allow for somebody to stay in their house, plus the outside care of a long-term care home, or somebody perhaps might want to stay in their house.
Yeah, bring the care into the house.
Yeah. And truthfully, this is often a transitionary experience for a lot of couples. So let's say one of the spouses were to pass, and the healthy spouse now remains in the house, and everything works out. And the kids aren't having to come to bear to try to make up the difference and things like that, and making an uncomfortable experience for the family. It's just, mom and dad are taking care of themselves. And it's sometimes sad, but it's awfully gratifying to be involved in those situations, to help out, people age in place.
Yeah. And, going to inheritance now, we talked about equalizing with a spouse that you're separating from. Let's talk about just your general legacy planning for your kids and grandkids. How are we seeing reverse mortgages being used in this way?
Yeah, and it's a major focus Jeff has been talking about recently is, like a pre-gift or a living gift to a child.
Yeah.
And from experience, what I find is it's usually more of a living equalization. You got to hear me out here on this, is when you actually look and open up the books of a family, you find out that mom and dad often have lent one child, $50,000, another child, $100,000 for their business, and another child got nothing. And so going into a potential estate situation down the road is there's this inequity when in fact the last will and testament is set up for an equal division. So the reverse mortgage has this great potential to give that little boost or equalization payment perhaps to the child that didn't receive anything, so that they go into a parity situation down the road in an estate. So all debts have been settled up within the family, right? And everybody's equalized. And that's really, really common.
No, I like this. And I'm always for the die with zero approach. We have all this planning in place to leave behind a large legacies for those you leave behind. But assuming you live a nice long age, by the time you pass away and all this passes along to your children, they are also retirees, presumably by that point, who have accumulated their own assets. They've long since passed the hardest parts of their life of getting started with the family, getting that down payment on a home, et cetera, et cetera. If I feel like, you really want to help people out, if giving is part of your financial plan, do it while you're alive. Give it while it has its highest utility to your kids. They just finished school. They've got student loans. They want to buy a home or they want to get married. So
plus, as the person gifting, you can see how it's being used.
Yes, exactly. If I'm gifting, I get the joy of seeing that utility take place. So this is fantastic. So reverse mortgages, they'll let you, buy that Cadillac when you're older. They'll let you buy that extra property. They'll let you renovate so you can flip the house for higher or whatever it may be. It'll let you, make sure you can age in place. It'll let you equalize payments. What can't this do? We've gone through a lot.
It's as creative as the advisor can get.
That's true.
That's fair.
That's true.
Which reminds me, before we close off, one sort of topic I'd like to bring up is the advisor themselves. People often ask if our business is growing. And so HomeEquity Bank overall is definitely growing very, very quickly. We do 5 times as many chip reverse mortgages today as we did even 5 years ago. And we have 8,000 or 10,000 Canadians calling our 1-800 number every month to inquire. And we know that a significant portion of those have a financial advisor. And our job at HomeEquity Bank is to engage with advisors and get them involved in that process. We'd like nothing more than the advisor to have sort of a seat at the table in this discussion and thinking through with the client. But sadly, too often, they're working on their own. And so our appeal through Advocis would be get to understand the product as an advisor, engage with us and your client, because they're coming to us without the advisor. So please come to the table.
Well, you know what? In that line of thought, and I'm not the only one thinking this, is there a monetary incentive for an advisor to bring this to you? Is there any sort of compensation for the advisor?
We do have referral programs in place that when we meet, we can get into the details of that, but there's absolutely advisor referral. We also have, if an advisor, because sometimes advisors don't want to be compensated for whatever reason, we also have a program in place to help the end client in lieu of the payment. So we have some creative ways to make this worthwhile for the advisor or the end client.
Well, that was very informative. I see you've got a book here on the table. Do you want to maybe show that to the camera and tell us what it's about?
Absolutely. And we'd be delighted to get this off to any of the Advocis members here. It's a book written by our Senior Executive Vice President Yvonne Ziemecki and our retired president recently, a pet project of case studies. So, we've mentioned a few here today. There's another 15 inside the book of people that have benefited. And, it's always a business of surprise and delight, is that people will, if they are open-minded, overcome a little bit of the mythology, realize that some of this thinking might have been wrong in the past, then they can see application. And, a tip to the wise to Advocis members is the first person that likely one of your members is thinking about is a family member that they deeply, deeply know their financial situation. And it typically is the first person that's referred to us. But compensation aside, I think, what I think is one of the major drivers for a member of Advocis is control. You want to be known as, I guess, the advisor of record. There's no good if somebody has a reverse mortgage, but you're not essentially on the file. Yeah. Because these things have to be managed over a long period of time. So why would you not, whether compensated or not, why would you not want to be the person essentially steering the ship for the overall financial plan? That would be the number one reason that I'd get involved and learn and overcome mythology, get the book, and definitely engage us.
Thank you. Well, that's Home Run, The Reverse Mortgage Advantage, written by Stephen Ranson and Yvonne Ziemecki. Perfect. Well, thank you both. Are there any final closing thoughts that you want to share? A little nugget takeaway?
I just thank you for having us on the podcast. And we've been a national sponsor of Advocis now for 2 years, I think. And we're very, very happy and excited to continue that relationship.
Yeah, and a sponsor of my local chapter, Advocis Toronto. So we really, really appreciate that.
Cindy, really appreciate the opportunity to be here. And again, it's all about dialogue and conversation. This is a start likely for many that they're tuning in. But we, HomeEquity Bank, we're staffed up in order to make sure that every question is answered. And there's no good if it's not a good fit. So let us show you specifically where a reverse mortgage could be a great fit.
Yeah, and you're both very approachable and easy to talk to if anyone needs to learn more. So this was great. Thank you again, Andrew Cairns and Jeff Thorsteinson from HomeEquity Bank. And that was today's episode. Thank you for joining us.